Welcome to Live Think Tank. This channel attempts to provide insights on the global economy, legal reforms, and cultural conflicts. It presents observations and develops strategies on how to adapt to the constant changes and receive benefits in the life practice. We will review lots of figures and charts in this video. It may be a bit boring if you are not familiar with the topic, but I will try to make it as plain and understandable as possible. And for the sake of simplicity, any amount I refer to in this video is US dollars. For example, when I say 400 billion, it refers to 400 billion US dollars or its equivalent. Hope you enjoyed the video by the end of it, and let's get started. The trade tension between US and China has been escalated. Are we expecting to see a proliferated trade war? And who will win this battle? Since early 2018, US has slapped steep import tariffs on a variety of goods, particularly including steel imports. The moves were purported to directly target at China, with which US had over 300 billion trade deficit in 2017. In response, China increased its tariffs by up to 25% on agricultural goods from US. This attempts to hurt US farmers since lots of them are from Trump's supported states. A very strategic move by China, which in most cases could discourage US political motivation. But Trump refused to back down. Instead, he proposed 25% tariffs on more products worth $50 billion. When China quickly retaliated, Trump took a further step, purporting to put on additional tariffs on goods worth $200 billion. China then firmly stated that they would take qualitative and quantitative measures to match the odds. Such tit-for-tat went a while until 6 July 2018, Trump unleashed the trade war by slapping the tariff being $34 billion US dollars worth of Chinese goods after midnight. As a result, we see interesting news about a ship carrying US soybeans was racing to beat Chinese new tariffs before the deadline. It didn't make it, unfortunately, but it's funny how it caught public's attention, and various jokes were made among internet users in both countries. Apparently, there will be negotiations back and forth, with each side threatening to impose more tariffs on more goods worth more money. But eventually, you can assume China and US will review and revise their confrontational stance over time. I think most people would understand that such trade war may disrupt the balance of the existing international trade regime and may even trigger a global economic crisis. But the current market performance suggests that it was something really expected. It seems that people know such trade war will hit them sooner or later, and it doesn't really come as a surprise. From a hindsight perspective, the US has a historical dispute with China on its espionage on acquiring US technology and trade secrets since Obama administration. Such issue was prioritized in the new government's agenda. Trump basically kept his promise going back to June 2016 to use Section 301 to crack down China on the alleged unfair trading practices. China, on the other hand, seems to come with preparation for a long time and has positioned itself to deal with the fallout of a trade war with the US. Predicting such confrontation may become inevitable, China has started looking for alternative sources for goods that it used to import from US years ago. China has initiated Belt Road project from 2013. From a geopolitical perspective, the project is designed to circumvent US military influence in Asian-Pacific region and potential boycott through the First Island chain. From an economic point of view, the project focuses on integrating Chinese economy with Euro-Asian countries, leveraging its infrastructure expertise, and resolving Chinese overcapacity issues. China has also formed comprehensive strategic partnership of coordination with Russia. The economy of Russia greatly suffered due to sanctions by Western countries. As a result, China took the advantage to trade with Russia in favorable terms to import energy and raw materials and export consumer products. It is my view that this trade war is pretty much anticipated by both sides. The root has been planted for almost a decade, and the trade war is just one of the fruits of many. The only things remain unknown are when would trade war happen and to what extent it will proliferate. Right now, China and the US are dancing around, measuring each other, knowing it could be a costly exercise, but also preparing to take this to the next level if necessary. So who can win this trade war? The more convenient answer is US as a matter of mathematics. US exports to China 130 billion goods every year, but China exports 405 billion goods to US. In fact, no country exports as much to another as China sent to US. Besides, there is a great number of jobs in China that are supported by access to US consumer market. At the moment, approximately 1 in 150 jobs in US are supported by exports to China. But that number is 1 in 70 on the other side. If US is determined to play the hardball by imposing tariffs on goods worth something like 450 billion, China would be out of bullets than US are, and its employment will suffer due to difficulty of replacing a consumer market on the same scale the US offers. Even worse, China at this stage cannot afford to proliferate the trade war to have the disruptive impact on its supply chain or jeopardize its core interest in technology industries. Without US-made chips, software, and other equipment, Chinese companies like ZTE will be under massive pressure to meet its global orders and maintain the momentum of research and development that have been continued for years. Companies like ZTE are heavily invested by the Chinese government and are regarded as cornerstone to Made in China 2025 plan. The plan attempts to transform the country from a labor-intensive economy to technology-driven economy. It is the future that China cannot afford to lose. If US decides to take extreme measures, for example banning all Chinese technology giants from using Google Android's operating system, or boycotting exportation of chips to China, it will be difficult for China to match the odds. Therefore, the need for China to maintain the relationship as status quo is far greater than that of US. At this stage, it is fair to say that China needs US more than US needs China. But saying that China might lose the trade war is just a convenient answer because the situation is far more complicated. After all, only 3% of Chinese GDP is attributed to US exports. The trade war per se would not hurt China as hard as we imagine. It is the timing of this trade war that could be more damaging than anything else. It is my view that there are more profound reasons for this trade tension at this particular time, and these reasons are far beyond trade. To understand the complication, we have to first understand the causation of trade deficit. The reason I said that this trade war was not just about trade is because if you look at the trading interests of two countries, China can produce many goods at lower prices, and the US want these goods for the lowest price. China are willing to work and produce, and Americans are willing to invest and consume. From a pure trading perspective, these two economies supplement each other pretty well. Some people may argue that such trading relationship is ill-balanced due to large trade deficit. However, the real reason that US suffered trade deficit is it spends more than it earns. Trade is about exchange of goods. Exchange of goods requires supply and production of substance. US no longer leads the world in industrial production. When China surpassed US to become the largest world manufacturer, US has been transformed to a finance-driven economy. Such hollowing out of industry is similar to what Britain experienced in the 1980s. After all, building a financial empire can maximize US return on capital via global investment. Everyone wants to make easy money and avoid hard work. To US, such dream becomes possible when it has the world's dominant currency, US dollars. If we look at history, After US abandoned the gold standard in 1971, it has constantly implemented the policy to expand trade deficit, whereby maximizing injection of US dollars to other countries. This is because when US dollar is no longer backed by gold, injecting US dollars to a foreign country would affect to control that country's wealth. As a matter of fact, you don't need to earn certain assets. You just need to control them so that they can be used for your best interest. Similarly, US doesn't need to directly earn other countries' assets. As long as US dollar is the dominant currency and is used by all the countries, US literally has the power to create and control other countries' assets. And the profits generated from such assets management is not just based on the skills of US economy, but based on the skills of the entire world's economy. Such wealth creation cannot be achieved without keeping transmitting US dollars to other countries, and such currency transmission cannot be achieved without expanding trade deficit. Therefore, trade deficit is exactly what US wanted. Trade deficit is the only way to maintain US dollar's dominance. And the supremacy of US dollar is the most important object among US policies. Therefore, it is absurd to criticize China as the creator of US trade deficit. But why US suddenly decided to overturn its strategy and compel China to reduce the deficit by at least 200 billion? To me, this number is well calculated to crack Chinese financial safety net, its US dollar exchange reserve. As you may know, China has the largest foreign exchange reserve. Chinese central bank holds approximately 3 trillion US dollar as foreign exchange reserve, including 1.2 trillion US bonds. At first glance, it seems to be impossible to pierce such safety net. But if you look into the statistics in details, you may find it is now the perfect timing to crack it. Firstly, China has issued 1 trillion US dollar bond. Therefore, among the remaining 3 trillion reserve, at least 1 trillion must be maintained for paying Chinese treasury's debt. Secondly, there are approximately 1/3 of Chinese reserve are euros and Japanese yen. Therefore, they are not US assets. There is only 1 trillion US dollar left, among which 200 billion were used to purchase bonds issued by Fannie Mae and Freddie Mac, and these assets cannot be traded immediately. Besides, approximately 150 billion were used every year on Belt Road investment. Lastly, a country normally would maintain foreign exchange reserve that could support at least 3-month imports. This would mean China has to reserve over 400 billion for any emergency situation. Then how much US dollar China can actually use in its reserve? It is less than 200 billion. The Chinese central bank's US dollar reserve reached its vertex points being $4 trillion in 2014 and has dropped back to $3 trillion in 2016. That is $1 trillion cut for mere 2 years' time. That's a clear indicator for assets bubble. When Chinese economy starts to slow down, when its property values become hugely overestimated and its currency continues to depreciate, the chances are that foreign investors would like to sell off their Chinese assets, convert them into US dollars and move to somewhere else. Therefore, the remaining 3 trillion US dollar reserve could be consumed rapidly without intervention. Understanding these statistics, you would understand why China was panicking in June 2016 when it lost 300 billion foreign currency reserve within 12 months. Such decline is more impressive considering China has gained 400 billion US dollar trade surplus in both 2015 and 2016. That means it was almost 1 trillion loss within a year. There is no explanation other than that US dollars are flowing out of China at staggering speed. Starting from that point, China has strengthened its restrictions on foreign currency exchange. Every Chinese citizen now has an 50,000 US dollar annual exchange limit, and the purpose of exchange is limited to consumption and must be registered with the state registration. This means that if you are a Chinese citizen and would like to travel overseas, you could only exchange no more than equivalent of 50,000 US dollars from Chinese central bank. And you could only spend those money on food, drinks, or air tickets instead of buying other assets. Now you understand why Trump administration demanded China to help reduce US trade deficit by $200 billion. $200 billion happened to be the only US dollar reserve China could instantly manage to deter any organized short selling against RMB currency. This is a well-calculated political step, putting China on its back foot and exhausting all its US dollar foreign exchange reserve. But why is it so important for US to crack China's foreign exchange reserve? Why China has to defend its reserve at all costs? Are we expecting to see a currency war after this trade war? We will discuss these questions in the next video. Make sure you click the subscribe button below to be reminded for my next episode on the same topic. Otherwise, I will see you next time.